Okay, so the Fed's been cutting rates, but honestly, the economy, it just still feels a bit shaky, you
Yeah.
know? So anyone looking into low-risk investments right now is being smart, whether it's an emergency fund, a short-term goal,
hmm
or just like a stable base for a portfolio.
Yeah.
And that's why we're doing this deep dive into Bankrate's 10 best low-risk investments in 2025
Okay.
to see what's worth considering in the current climate.
That's a great resource to start with.
Yeah.
I think they've really done their homework on
Yeah.
what's performing well this year.
Yeah, they kick things off with high yield savings accounts. And
Yeah.
I feel like a lot of people just kind of stick with whatever their local bank offers.
Right.
But Bankrate stresses that shopping around online is key
Yeah.
to really maximizing those returns.
It is. And the beauty of these accounts is the FDIC insurance
Right.
up to 250,000.
Yeah, that's.
That limit actually came about after the Great Depression.
Oh, wow.
When so many banks failed and people lost their life savings,
Yeah.
that safety net really gives you peace of mind.
I did not know that about the history of FDIC insurance.
Yeah.
Okay, so high yield savings accounts,
Mm-hmm.
super safe.
Mm-hmm.
But what's the catch?
Well, the returns might not always keep pace with inflation.
Right.
You could end up with more money in the account,
Okay.
but your purchasing power might actually be lower.
So it's not a set it and forget it solution for long-term growth,
Right.
but for an emergency fund, it
Yeah,
seems like a solid choice.
it is.
Now, Bankrate also mentions money market funds.
Yes.
I've always been a little fuzzy on those.
Okay.
What exactly are they?
Think of them as a way to dip your toes into diversification.
Okay.
They pool investments like short-term bonds and CDs to spread the risk.
Okay.
You get regular interest payouts,
Mhm.
often monthly,
Okay.
and it's usually pretty easy to access your money.
So more flexible than a CD,
Yes,
but maybe with slightly lower potential returns.
essentially.
How do you usually weigh those trade-offs?
Right. It all boils down to your time horizon.
Oh,
If you're saving for down payment in a couple of years,
right.
you want that liquidity.
Oh, okay.
But if you're looking at a longer-term goal,
Mm-hmm.
locking in a slightly higher rate with a CD might make more sense,
Okay.
especially now
Yeah.
with Bankrate, specifically recommending short-term CDs
Right.
because we're in a potentially rising rate environment.
Yeah, that's a good point. You wouldn't want to be stuck with the low rate for too long if rates start climbing.
Exactly.
They also mention no penalty CDs.
Yes.
Those seem intriguing.
Those are great if you want a bit more flexibility.
Okay,
You can withdraw your money without the usual penalty,
gotcha.
so you can snag a higher rate if one becomes available later on.
Ooh, that's smart. Okay, next on Bankrate's list are cash management accounts.
Okay.
These seem like the all-in-one solution for people who like to keep things simple.
They're definitely convenient. Think checking account,
Yeah.
savings account, and an investment account,
Oh, wow.
all rolled into one ride. Plus, they often have features like check writing and debit cards.
And that automatic sweep feature
Yeah.
where unused cash goes into a money market fund
Mm-hmm.
is pretty clever.
It is, but you have to watch out for variable interest
Right.
rates
Right.
and potential fees.
Yeah, good reminder. Okay, now we're getting into territory that always makes my eyes glaze over a bit.
Okay.
Treasuries and tip piece.
Okay.
Help me out here.
No worries. They're not as complicated as they sound.
Okay.
Treasuries are essentially loans to the U.S. government.
Right.
They come in various maturities,
Okay.
from short-term bills to long-term bonds.
And they're considered super low risk because they're backed by the full faith and credit of the U.S. government. Right.
Exactly. Now, TPS, or Treasury Inflation Protected Securities,
Okay.
are where things get a little more interesting.
Okay.
Their principal value actually adjusts with inflation,
Oh, okay.
so your purchasing power is protected.
Hold on, walk me through that again. How does that actually work?
Let's say you buy a $1,000 TPS bond, and inflation goes up by 3%.
Okay.
The principal value of your bond would increase to $1,030.
Okay.
So even though the interest rate might be fixed,
Right.
the value of your investment keeps pace with inflation.
Okay. That's actually pretty cool.
Oh,
But Bankrate also mentions interest rate risk,
yes.
especially with longer term bonds.
Mhm.
What's the deal with that?
When interest rates rise, the value of existing bonds tends to fall.
Okay.
It's because investors can now buy newer bonds with higher interest rates, making the older ones less attractive.
Gotcha.
So if you had to sell your bond before it matures in a rising rate environment,
Yeah.
you might lose money.
So if you're worried about rising rates,
Mhm.
it's best to stick with short-term treasuries or TPS.
That's a good strategy.
Okay.
Now let's venture into the world of corporate bonds.
Okay.
They're issued by companies,
Okay.
not the government.
Right.
So they come with a different kind of risk.
Right. Default risk.
Yes,
The chance that the company might not be able to pay back its debt.
exactly.
That feels a bit more, well, risky than treasuries.
It can be.
How can you tell which corporate bonds are safer than others?
You want to look at bonds issued by financially stable companies
Okay.
with a solid track record.
Okay.
Diversifying your bond holdings, maybe through a bond fund,
Right.
can also help mitigate that risk.
So corporate bonds, potentially higher returns than treasuries,
Yes.
but with that added element of uncertainty.
Yeah,
It's all about finding that balance, I guess.
precisely. Are you ready for something a little more exciting?
Oh, I love a little excitement. What are we talking about?
How about dividend-paying stocks?
Okay.
They offer the potential for growth
Okay.
and regular income.
I've always found them intriguing, but aren't they still riskier than, say, a high-yield savings account?
They are.
Yeah.
The 2008 market downturn, for example,
Right.
showed us that even well-established companies can cut or eliminate their dividends
So, wow.
in tough times.
Okay.
But generally, they're considered less risky than growth stocks
Okay.
because dividend-paying companies tend to be more established and mature.
Okay, so not without risk, but potentially a good way to add a little more growth potential to a low-risk portfolio.
Exactly.
But what about preferred stocks?
Okay.
Those always seem a bit mysterious to me.
They're kind of like a hybrid
Okay.
between bonds and stocks.
Okay.
You get regular dividend payments like bonds,
Uh-huh.
but their value can fluctuate like stocks.
Wait, so those dividends aren't guaranteed?
Companies can technically suspend preferred dividend payments
Oh, really?
in certain situations,
Yeah.
but it's generally a last resort.
Okay.
They'd usually have to make up any missed preferred stock dividends
Yeah.
before paying dividends to common stockholders.
Interesting. So they're kind of in between bonds and common stocks in terms of risk and potential return.
Exactly.
Now, I'm a little confused. We already talked about money market funds,
Mm-hmm.
but Bankrate also mentions money market accounts.
Right.
What's the difference?
Good catch. They invest in similar low-risk securities,
Okay.
but money market funds are mutual funds,
Okay.
while money market accounts are deposit accounts offered by banks and credit unions.
So money market accounts are FDIC insured,
Yes,
just like savings accounts.
exactly.
Sure.
Up to $250,000 per depositor per insured bank. You have that added layer of security,
Right.
which you don't get with money market funds.
Okay, that makes sense. But do money market accounts usually have higher interest rates than regular savings accounts?
They often do,
Okay.
but not always.
Okay.
And they might come with higher minimum balance requirements
Right.
or
Yeah.
limits on withdrawals.
Got it.
Yeah.
Always something to consider. We've covered a lot of ground here. High yield savings accounts,
We have.
money market funds,
Mm-hmm.
short-term and no penalty CDs,
Yes.
cash management accounts,
Mm-hmm.
treasuries,
Those, huh?
TPS,
Mm.
corporate bonds,
Keep going.
dividend-paying stocks,
Yes.
preferred stocks, and money market accounts.
Yes. That's a lot.
But wait, there's one more thing on Bankrate's list, right?
You're right.
Okay, good.
We haven't tackled fixed annuities yet.
Okay, let's dive into those.
Okay. So fixed annuities,
Okay.
they can seem a bit complicated at first glance,
Right.
but the basic idea is this.
Okay.
You give an insurance company a lump sum of money,
Mm-hmm.
and in return, they guarantee you a fixed stream of income
Okay.
for a set period, maybe even for the rest of your life.
So it's kind of like creating your own personal pension.
Exactly.
That sounds appealing, especially as you're thinking about retirement income.
It can provide a sense of security,
Right.
knowing you have a guaranteed income stream
Yeah.
you can count on.
But I imagine there are downsides, too.
Grace,
Of course.
nothing's ever perfect
You're right about that.
in the world of investing.
One of the biggest drawbacks is liquidity.
Okay.
Once you've put your money into a fixed annuity,
Yeah.
it can be difficult and expensive to access it
Okay.
before the payout period begins. Ah, so you really have to be committed to the long haul with these.
You do.
What about inflation?
Yes.
Doesn't that eat away at the value of fixed payments over time?
That's another important consideration.
Yeah,
Since the payout is fixed,
right.
if inflation spikes,
Yeah.
your purchasing power could erode.
So it's a trade-off,
Mm-hmm.
guaranteed income,
Right.
but potentially less flexibility and
Yeah.
vulnerability to inflation.
That's right.
Lots to think about. Okay, we've explored all 10 of Bankrate's recommended low-risk investments.
We have.
I have to admit, I'm feeling a bit overwhelmed.
Okay.
How do you even begin to narrow down the choices?
That's where things get personal.
Okay.
It's not about finding the best investment in a vacuum,
Right.
but rather the best fit for your specific circumstances.
You're saying it's not a one-size-fits-all situation.
Exactly. The first step is figuring out your goals.
Okay.
Are you building an emergency fund that
Yeah.
needs to be readily accessible?
Mm-hmm.
Saving for a down payment on a house in a few years?
Yeah.
Or planning for retirement
Mhm.
decades down the road?
Right. Your investment strategy for a short-term goal is going to look very different from a long-term one.
Absolutely. For short-term goals, you prioritize liquidity and safety.
Okay.
Think high-yield savings accounts
Mhm.
or short-term CDs.
Okay.
But for long-term goals,
Yeah.
you have more time to ride out market fluctuations.
Mm-hmm.
So you can consider investments with slightly higher risk
Okay.
and potentially higher returns.
Okay. That makes sense. So goals are a big driver. What about risk tolerance?
Mm-hmm.
How do you figure out how much risk you're comfortable with?
It's a bit of soul-searching.
Okay.
Think about how you'd react if your investments lost value.
Right.
Would you panic and sell everything?
Uh-huh.
Or would you stay the course,
Okay.
knowing that markets go up and down?
I think a lot of people think they're more risk tolerant than they actually are
Yeah.
until they actually experience a market downturn, that is.
That's so true. It's easy to be bold when the market's going up,
Yeah.
but real risk tolerance is
Yeah.
tested when things get bumpy.
So, are there any tools or resources that can help people assess their risk tolerance
Mm-hmm.
more objectively?
There are a lot of online questionnaires and risk assessment tools that can give you a starting point.
Okay.
And of course,
Yeah.
talking to a financial advisor can be incredibly helpful.
Yeah, a financial advisor can bring that outside perspective
Right.
and help you make decisions
Mm-hmm.
without letting emotions cloud your judgment.
Exactly.
Okay, so we've got goals and risk tolerance.
Yes.
What other factors come into play
Okay.
when you're choosing low risk investments?
Diversification is key.
Okay.
Remember the money market funds we talked about?
Yeah.
They spread your money across different investments
Right.
to reduce the impact of any single one performing poorly.
Right. Don't put all your eggs in one basket. As
Nathan,
classic investing advice.
it's timeless for a reason. Diversification is your friend,
Right.
especially when it comes to managing risk.
Yeah. And speaking of things that can impact your returns,
Mm-hmm.
don't forget about fees and expenses.
Oh, yes. Those pesky fees. They can really eat into your profits over time.
Yeah.
Absolutely. Always compare the expense ratios of different investment options,
Right.
whether it's a mutual fund ETF
Huh?
or annuity.
Okay.
A seemingly small difference in fees can make a big difference in your returns over the long run.
Okay, so diversification and fees.
Mm-hmm.
Got it. Anything else we should be mindful of?
Taxes.
Oh, right. Yeah.
Different investments have different tax implications.
Right.
For example, interest earned on certain types of bonds is taxable,
Uh-huh.
while Roth IRAs offer tax-free growth and withdrawals.
Right. Taxes can make a huge difference in your overall investment performance.
Absolutely.
It's definitely worth understanding how different investments are treated from a tax perspective.
Yeah.
So we've covered time horizon,
Mhm.
risk tolerance,
Yes.
diversification
Yeah.
fees,
Yep.
and taxes. Anything else we're missing?
I think it's important to remember that investing is about more than just numbers on a spreadsheet.
What do you mean?
Low-risk investments are about peace of mind.
Okay.
They're the foundation
Yeah.
that allows you to pursue other opportunities,
Okay.
maybe even take on a bit more risk in other areas of your portfolio,
Right.
knowing that you have a solid base to fall back on.
That makes a lot of sense. It's like having that secure base camp so
Exactly.
you feel confident exploring further afield.
Yeah.
And speaking of exploring, maybe we could take a look at some moderately risky investments sometime that could like supercharge those returns.
Yeah.
But that's a deep dive for another day.
Exactly.
So for now, we'll wrap up our exploration of these low risk options. What are the key takeaways you want our listener to walk away with today?
I think low-risk investments offer stability
Mm-hmm.
and they help preserve your capital, especially in times like these when things are so uncertain.
Right.
The returns might not always outpace inflation over the long run,
Right.
but that's not really the main goal here.
Right.
It's about building a solid foundation.
It's like having that financial safety net so
Exactly.
you can take some more calculated risks
Right.
in other areas of your life.
That's a great way to look at it.
It's funny, we often talk about investments as these abstract concepts,
Mhm.
stocks, bonds, funds,
Right.
but ultimately it's all about people, isn't it?
It absolutely is. It's
Yeah.
about helping people achieve their financial goals.
Yeah.
secure their future,
Mm-hmm.
and create the life they want to live.
Yeah.
And for many people, low-risk investments are a vital part of that journey.
I love that perspective. It's not just about numbers on a screen.
Yeah.
It's about what those numbers represent.
Mm-mm.
Freedom,
Yes,
security, peace of mind.
that's right.
It's about empowering people to pursue their dreams knowing that they have a strong financial base to
Yes.
support them.
And as we've discussed, even within the realm of low risk,
Right.
there's a wide spectrum of options
Definitely.
to choose from.
Mm-hmm.
It's not a one-size-fits-all approach.
Exactly. And that's why it's so crucial to do your research. Understand the nuances of each investment type.
Yes.
And figure out what aligns best with your own unique circumstances.
I couldn't agree more. Sometimes the best investment you can make is in knowledge
Mm-hmm.
and professional advice.
Right. Yeah.
Talking to a financial advisor can be invaluable,
Yeah.
especially if you're feeling overwhelmed or unsure where to begin.
Yeah.
They can help you create a personalized roadmap,
Okay.
answer your questions,
Right.
and provide guidance along the way.
Even if you're a seasoned investor,
Yeah,
a fresh perspective can never hurt.
you're absolutely right. Financial planning is an ongoing process.
Mm-hmm.
It's about adapting to changing circumstances,
Yeah.
revisiting your goals,
Mm-hmm.
and making adjustments as needed.
So as we wrap up our deep dive into low-risk investments, what's the one thing you want our listener to remember?
Embrace the power of low-risk investments as a foundation for your financial well-being.
Okay.
Don't underestimate the value of stability and security.
Beautifully said. Low-risk investments may not be the most glamorous or exciting part of your portfolio,
Right.
but they're the bedrock
Yeah.
of a sound financial plan.
Exactly.
They give you the freedom to pursue other opportunities,
Mhm.
take calculated risks,
Yes.
and ultimately achieve your dreams.
Well said. And who knows, maybe this deep dive has sparked an interest in exploring those moderately risky options we mentioned earlier.
Yeah.
There's always more to learn and discover on your financial journey.
That's a deep dive for another day.
Exactly.
For now, remember, knowledge is power. Keep learning, keep exploring, and keep building towards a brighter financial future.